In terms of a definition of credit, credit is sort of an allocation where somebody is offering you the potential to take money in the form of a loan. And sometimes people don't realize that. When you use your credit card and you swipe it, you're in essence borrowing money from the credit card company. They're paying for the purchase with their money, and then they're billing you for it. So the idea is it's just like taking out a car loan or a mortgage or anything else. In today's society, of course, it's so easy that all we do is swipe it. You know, somebody said they became a master swiper. Just swipe it, credit card spins around, goes right back in your pocket. You know, because it's so easy to do that. What you just did is you took out a loan, and you're going to be paying for it for a long time. So one of the things about using credit responsibly within finance, we have something we refer to as the matching principle. And what that says simply is we don't want to borrow money for a longer period of time than whatever we're using the money for is going to last. So a ridiculous example of that would be we wouldn't want to take out a mortgage on a car because we wouldn't want to finance something for 30 years that we might drive for 2 or 3. We wouldn't buy a house with a credit card because the interest rate and the payback period would need to be so short, we wouldn't be able to handle that on such a substantial purchase. So credit, again, is something where somebody is allowing us to borrow money on a pre-approved basis, and it's the utilization of that credit in a responsible way that drives our credit score. Regarding how one would establish credit initially, you apply for it just as you would for a loan. So if you think about the differences between going in and applying for a car loan, you fill out a considerable amount of paperwork, they run your credit score, which we'll talk more about in a second, and based upon your credit history, your income, and a number of other factors, your employment stability and so on, they decide whether they're going to loan you money to, in essence, finance the car under some terms. Credit cards are really the same thing, where the credit card company has had you fill out some paperwork, they've evaluated your credit, looked at your credit score, and they've established a predefined limit up to which they're going to allow you to use that credit card. So an example would be they might say, okay, you now have a line of credit available on your Visa card up to $5,000. You can spend up to $5,000. You pay on the card. As you pay it down, you can again charge back up to $5,000. And the problem, of course, is that some people take out multiple cards and then the debt level starts to increase with lots of payments at relatively high interest rates.